Hello and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, on a recent podcast, we outlined how the One Big Beautiful Bill will help you protect and grow your assets. Today, we're going to dive a little deeper into the conversation as we address the three questions small business owners should ask about cost segregation under the OBBB, or One Big Beautiful Bill. Stay tuned for that. Now, thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. So on today's episode of the podcast, we're going to build on a fan favorite episode, the three questions you should ask about cost segregation, by diving into how the groundbreaking One Big Beautiful Bill, or OBBB as some call it, has the potential of supercharging these tax saving opportunities. So what's our topic today? The three questions small business owners should ask about cost segregation under the OBBB. Joining us once again, an encore presentation here, is my friend Joel Dobrin from Camarillo, California. He is a renowned cost segregation specialist, and he's a partner with Baton Rouge, Louisiana-based Cost Segregation Initiative. Joel, I have this vision in my mind of you just like racing to the camera. Just can't wait to talk about this. So stoked. Great to see you again, my friend.
Wayne, it is great to see you. You are 100% correct. And I think that I would maybe just start off by saying that the Big Beautiful Bill brought to life the 100% bonus depreciation component to cost segregation. And as a result, we think that this really could be the single most powerful strategy that is available to owners of commercial and rental income property today.
So when the OBB was signed, and irony of it is, I couldn't help but think of it when thinking of you, on July 4th, on Independence Day, no less, right?
Right.
Like that's got to be like a day of celebration for you.
A day of,
My
I think it was, I'm just going to say, I think there was somebody that decided we're going to really spite Uncle Sam. We're going to do it right on Independence Day.
Yeah. So to me, I'll tell you right now, it was a no-brainer that I wanted to have you back on the podcast. And as they would say and goes, this is huge. This is a big deal.
100% correct. Yes, it truly, truly is. It's the opportunity for, again, for owners. You know, I talk about the impact of 100% bonus depreciation, but what does that really mean? Just in simple terms, it's just the opportunity to greatly enhance immediate tax savings. And I know you have some questions, and we can kind of delve
You're
into
here to
that a
answer
little
the three
deeper.
questions, and
Uh,
why don't we get right to Joel? No further ado. I'm thrilled that you're here. Glad you made it. So let's get right to the three questions business owners should ask about the One Big Beautiful Bill. Let's get started.
okay.
Question number one. My partner and I just purchased a building for our medical practice for $5 million, and we have an estimated $1 million is the value of the land. How will the One Big Beautiful Bill allow us to maximize our tax savings? Mr. Dobrin, take it away.
All right, Wayne, and I'm glad that you touched on the $5 million purchase, but also the $1 million land component, because in cost segregation, the land is not depreciable. So our focus is on that building. And medical buildings create really even more powerful opportunities, just given the nature of what they contain. And we're going to speak to a little bit more. We'll speak a little bit more about that. But in general, we've got $4 million of building basis. If that building was 39 and a half years, then the owner of that building, I'm just going to glance here quickly at my notes, they would have straight line depreciation of 101,265. Equal deductions year over year over year. Now, enter the big beautiful bill and the impact of bonus depreciation for this property. In cost segregation, we are going to go in and we are going to reallocate elements of the building to shorter life periods of 5 and 15 years per the tax code. Conservatively, because we've done many, many medical type facilities over our close to 20 years of doing this, we know that there will be 25%, and again, that's probably a conservative number for these types of structures. 25% of the elements that make up that building, we're going to be able to reclassify. So if we take 25% of that building, of that $4 million of building basis, now instead of having a deduction of $100,000, now
So
that
like $1
building
million.
owner will have a deduction of $1 million.
Yeah.
So again, simple math, if we have a 50% tax bracket owner, then on a straight line depreciation basis of 39 and a half years, there'll be about $50,000 worth of tax savings. But with cost segregation, now that 25% is going to create $500,000 worth of tax savings. To take it a step further, and very important, because the owner, typically if it's a medical professional, a physician, because they operate out of that practice, and this would apply whether it's a medical building or any other business owner that operates their business. Well, that benefit of cost seg typically is reflected in their K1. When that K1 is issued showing these losses, then that carries over and has a direct impact on the income that they are generating in their day-to-day business. So as you can imagine here, they're buying the building. They are basically their own tenant, paying themselves rent. So they're growing their own asset base. But in addition to that now, with the impact of cost segregation and with the new rules, the tax savings ramifications, as we see, $100,000 of deduction versus $1 million of deduction, pretty straightforward math.
So for a building like a $5 million medical building, what specific components are being accelerated? This isn't just like looking at a building. We've had conversations about this several times in the past, that you actually have to go into the building and look at it like piece by piece here.
Right. So again, because this is more, a medical building or a surgery center is certainly going to be different than your standard office building.
Okay.
And so we've got very specific elements that are different. And just a list that I made here. Think about the wiring and the panels that are utilized for x-rays, for MRIs, for any type of ultrasound or dental, moving chairs, etc. You've got things like compressed air systems, vacuum lines. There's specialized drainage that gets used. Of course, think about when you walk into a practice like that, the amount of cabinetry that you see, the countertops, specialty lighting, IT. These are just a handful of the examples that what we would see interior in a space like this. They would be moved to 5-year property. And I probably also should include things like call systems, communication systems. In addition, we're going to have exterior elements that qualify for accelerated depreciation. That goes under our land improvement component, the parking lot, the striping, the curbing, the sidewalks, irrigation, landscaping, exterior lighting, fencing. All of these things are able to be studied and then reclassified so that we're able to bring these benefits to the owner through the utilization of our study.
You know what? I just got a curveball to throw at you, my friend.
Yeah,
So let's say they have to obviously put some capital into this. Maybe they borrow money to pay to put implement this into the building. Would be logical that
right.
they may have to. So if they borrowed money to pay for all of this,
Mhm.
they are still eligible to apply for this tax break, correct? They don't have to wait for it to be paid off. So in theory, this could be a way of expediting the repayment of the debt they used to get this property in the first place.
Yes, in theory, correct. Because if they've borrowed money and they're going to do improvements, then what we're going to do, we're not concerned about the time that it takes for them to repay that in our focus. But what we're going to look at is we want to see the construction documentation and costs that are associated with that, because that's going to be the basis of our work. Taking a look at what is being done, what does it cost, and then how do we integrate it and apply it based on the rules. But to your point, if they were of the mindset, hey, we just want to accelerate paying off this obligation,
They could
well,
do
the tax
the
savings
tax.
that is going to be created could very well be used for that.
Well, Joel, that's why we have you here, and a really great answer to question number one. Let's move right on to question number two here on the podcast. Question number two, and it starts off with a point of reference here. In 2014, I purchased an apartment building for $8 million. This past February, I started making significant upgrades, approximately $2 million worth. How does the One Big Beautiful Bill enable me to maximize my tax savings? So in this case, it is an actual
So
renovation.
yeah. So a couple of things with respect to this question. First off, there is a finite amount of depreciation in every property, whether that be commercial or rental income. And it's important to note we don't create any more depreciation. We just accelerate the opportunity to utilize it. So in your example, the fact that the apartment building itself was purchased in 2014, here we are now in 2025. So there has already been 11 years of depreciation that has already been accounted for. So when we look at the core building itself, that really would take some analysis to take a look and say, well, based on what we've depreciated thus far, is it really going to make sense for us to have a full-blown study done on the building because of the fact that we have utilized depreciation to date? That being said, because there is going to be improvements that are going to be made, it leads us to another important piece to this puzzle. Let's say the improvements entail the removal and just the demolition, if you will, of taking out some of those older elements that exist. Well, even though they've been there for 11 years, they still have value. And now your question, Wayne, leads to another very important and often overlooked part of the cost segregation picture. And that's what we refer to as the disposition of elements.
Hmm.
So, although the building has been in service for 11 years, it still very well may make sense to have that building studied so that we can assign values to everything that it currently consists of.
Even before the
Why do
rental,
we
would you
want
want to do
that?
it before the rental even started? Would that?
Yes, exactly right. And here's the reason why. When we do our work, we are assigning value to each and every element of that building, line by line. I almost say sometimes down to every nut and bolt and screw that exists. Now, because of that, and because of the level of detail that goes into our reports, when the time comes for those items to be removed, taken out, demoed, etc., then the CPA will have a reference point of what value those current elements had. And rather than them just being discarded and forgotten about, then the CPA will be in a position to write those remaining values down to zero. And how does he know what those elements are worth? He refers to our study. That becomes the basis and the support for taking advantage of this. So in many instances, this also can end up being significant savings to be realized. So we've got the study that could make sense to be done because of the incorporation of the disposition of elements prior to any type of demolition that is going to take place.
Mm-hmm.
And then to your point, now, because we're going to do these renovations and improvements after January 19th of 2025, then the same impact applies. If there's $500,000 worth of improvements, then chances are we're going to probably find somewhere in the range of 20% of those improvements that are being made, if not more. And that 20% or $100,000 will all be bonus eligible. And it will enable the owner to take that deduction immediately once the work is completed. So,
Well, they
there's
get double
different
dipping in a
components.
way, in a roundabout way. You're kind of getting best of both worlds, the pre and post construction analysis.
Yes, 100%. And again,
Hmm.
let's just say that the if that building wasn't 11 years in service, maybe if it was only 6 or 7 years in service, then clearly there would be something to be said for having the study done on that building. That in and itself would make sense. And then again, the incorporation of the disposition component clearly adds to the savings that are created.
Another curveball. That's why you're here, my friend.
Yeah.
What percentage of business owners that own their own building actually go through with this exercise? Based on your experience. Again, this is subjective. I mean, you only have your universe, but
Right. No, it's really it's a great question. And I think that the best way I could answer it without really just guessing, if you will, is to say that although cost segregation has now been around, there still remains a pretty large segment of the real estate owning population that maybe has heard about it, knows a little bit about it, but there are far less that truly understand how impactful it can be given the current rules, number one. And also the fact that there are, just as we talked about, there's also additional components that come into play with the implementation of cost seg when you have folks that have had real estate for an extended period of time and then look to do these improvements. That improvement piece also, I mean, I will often hear from people, oh, really? We can do that? And the answer is absolutely yes. So I don't know if I gave you exactly the answer. I know
oh,
you
I
threw
didn't
a
expect you to
curveball.
give
So
me something. Didn't expect you to the third decimal point. I was just kind of curious if, I think the great news here is, we're doing our little part here, Joel, to help educate the public. And I hope lots of folks get to listen in and share and hear what you've got to share. And ultimately, there'll be people picking up the phone or shooting you an email down the road here. Uh,
Maybe we'll say this. You said a curveball, so maybe it was kind of a curveball. We got the bat on it, and it was a line drive, but it was, it was towards the foul pole. It didn't stay in play.
I think it's fine. So one
Okay.
other thing I wanted to go back to this property, with regarding this $2 million upgrade that we've been talking about, uh, is the recapturing the part where, like there's this recapture you talked about, recapturing depreciation. How why is it faster? Like what are the parts of the one big beautiful bill that makes this recapture why does it expedite the process? Can you take a Cliff Notes explanation just for the folks listening in?
Yes, and first off, let me say this. I think that you had originally said 2 million. If they spend 2 million in improvements, and I think I don't know if I used that $2 million number, so I apologize for that as we were
That's fine. We're
speaking.
good.
But again, how does it accelerate? It just comes back to those same fundamentals. Because if somebody was to do improvements to the existing structure, then per the rules, or if somebody was not aware of this, or if they just didn't even take the time to say, hey, I know that there are some of these items that can in fact be somewhat accelerated, then the improvements would be made. And on the depreciation schedule, they would simply be listed as 27 and a half year straight line improvements. And in many instances, when we're brought in to do these types of projects, we'll look at a depreciation schedule because we want to see that to begin with, because the building has been in service, as you said, bought in 2014. So there's already a depreciation schedule. And we'll look at that and we'll see how have things been allocated thus far. And in certain instances, even prior to us being brought in, there may have been other improvements that have been made. But what do we see? We just see a single line item. We see a total cost, and then we see 27 and a half years. So
Hmm.
this is where, again, we drill in. We want to see the construction cost budget, the construction cost data. If there's plans, drawings, we want to review those. That becomes the essence. That becomes the ingredients for us to be able to do the specialized work that we do.
So I'm going to be Captain Obvious and say obvious here and say record keeping is obviously essential. Um, how often do you get called into a client wanting your help? Explain to them the process that's involved, and they look at you and kind of put their hands up in the air and say, I don't have I don't have all my receipts, for simply put. Record keeping must be like that's the essence of what you do, Joel, is being able to report and record every piece, any type of activity on that building.
Right, right. So when it comes to with respect to, we're focused here on the improvement component,
Right.
if you will. So if they don't have good records,
Too bad,
then it
so
makes it
sad.
tough. It makes it tough because we need to be able to substantiate, document, and then support the positions that we take so that they tie back to the record keeping and to the tax return. And, in the event that there is ever an audit, and we don't know if that's going to take place, will it not? No one really knows. But in the event that it does, if there are positions that are taken and allocations that are taken for certain components of that building that really simply end up being guesses, probably not going to sit too well with the IRS. And it's not something that we really, we would just not be part of it, frankly. We would just say, this is, there's a certain way in which things are done in order to meet quality standards. That's kind of our mantra. We have an unwavering commitment to that. We won't take shortcuts or guess. So
Keep your
the record
records,
keeping
keep
is
every receipt.
keep correct. Correct. Now, last thing I will say, if we have a real good idea of what was done, and they can at least provide us what they paid for things. And it's specific to the individual subs or the general contractor. Then there are, in fact, values that we are to utilize per the tax law that we can, in fact, address some of this, but it is not as good as having the actual records. So yes, keep good records would be the proper statement.
Our guest today is Joel Dobrin. He is from Camarillo, California-based Cost Segregation Initiatives. And Joel, we're going to move on to question number 3 here. Again, a little background story first. I purchased our primary residence for $1.5 million back in 1990. I'm thinking of converting it to a rental property and expect renovation costs to be in the $500,000 range. So my question is this: does it make sense to, quote, cost segregate a rental property if it has a value of less than, say, $5 million?
Wayne, it's a great question, and it's a timely question because of the fact that there are so many more people that are getting into this space of buying second and third properties and converting them to rentals. It's a growing trend. We've done a significant amount of work in this area. There are some very key fundamental pieces that people need to be aware of. And I will speak here to here in California as we talk through this, because though we do work nationally, I think to make the point of value and how we start, California is a good reference point. The reason being the following. So when did you say we purchased? What was your date of purchase there? 1990. So that building here in California that was purchased in 1990, it is safe to assume and reasonable to assume that that piece of property is worth a whole lot more than it was when it was purchased in 1990. That one, I think we can all agree on that. So we have people that will contact us and say, hey, I bought this building or I bought this residence. I bought it in 1990 and I paid $1 million for it. But I know now that my $1 million property is now worth $4.5 million. And now I want to improve it. Right. I want to improve, and I'm going to do some improvements, and then I want to cost segregate the whole thing because I know now with at that value and with the rules, there's a boatload of savings for me to take advantage of. But here's the thing specific to this area. If you are going to convert a primary residence to a piece of rental income property, the rules state that for the initial basis of the property, we need to use the lesser of two values, that being the lesser of the original purchase price versus the value today. So I think pretty safe to say, question asked, question answered. We all know what the answer to that question is. As we said, the value today is.
They can't use the grossed up number. They can't use the fair. They have to use I was almost going to say the adjusted cost basis almost.
Right.
Or at least the purchase price.
The purchase price. That's
what the property is worth today. So.
Correct. So again, go ahead, please.
I would just say, so that leads us to the question: does it make sense to cost segregate a $500,000 renovation? Is there any there?
So again, now, and you kind of hit the good number. We'll say that we're going to set aside the core home because the value just doesn't merit it. Number one, and number two, they've been in there a long time. There may be a few things that when we study it to that initial building that we can look to grab, but it's not going to be significant. On the other side of the coin, we would see that even if people are spending $300,000 or more in those improvements, then there is a reasonable assumption that at the very least, we would want to go down the path and explore that. We'd want to get a deeper understanding of what those improvements are going to consist of. How are they going to be integrated into the current home? What are the finishes? What are the fixtures? What is the balance interior and exterior? Because again, those improvements will in fact be bonus eligible if they fit the criteria per the rules.
So even for a like sub $5 million rental conversion like this, what we're talking about, Joel, what makes cost segregation worthwhile under the one big beautiful bill? Like in this context, well, even if it's a small, a less expensive what property, and I guess there's one thing, there's a term that I kind of researched on, something called passive activity rules. So how does all this come into play as well?
So for the owner of that property, once they reach a point, and I'll say different from the initial in question one, just different from the owner operator of the medical building. If it's a
Right.
doctor or professionals there, they're running their business. So now we have owners that aren't involved in real estate. They could be W-2 employees that work for large companies, could be in the tech space, in the banking space. They could be, they could be a host of things, but they're not real estate professionals, and they still want to be able to benefit from having this as a rental property. So what happens is that they will need to be in a position and wait until such time that they actually do have, and they have generated enough in the way of rental income that they find themselves cash flow positive, specific and only from those rental activities. And once that has been established, then they are able to offset that income production through the integration of cost seg, but it is very narrowly defined and specific to the rents that are generated, that are collected, and ultimately, after all is said and done with the management and running of that property, that they still have profit that they are looking to be able to offset. And for some, that takes some time.
The key part though is the fact that they got to show generating rental income to be able to make.
Correct. If you're doing this and it's just going to be, kind of a break even, and you're happy with, okay, well, I'm going to get somebody in there and excuse me, I want to have a second piece of real estate. And if they pay my mortgage and they cover my expenses, and even if I'm even or I'm making a little bit more, I'm good. Well, if that's the case, then not sure it would make sense, and you don't necessarily need us.
All right. So building on your last appearance, where we really kind of was more cost segregation 101, or if you will, the basics. What's one big beautiful bill provision that really excites you the most? And this is from the perspective of a small business owner. And how can they start leveraging it right away without having to wait?
Well, I think for the small business owner, that owner operator, as I said, I think one of the things that it's just simply a lack of awareness, is that if they go out and they purchase a piece of real estate, or they've been thinking about it, but they just weren't sure if it made sense, within the context of knowing that if they purchase that building and now you have the opportunity to greatly enhance your immediate tax savings benefit, and as a business owner, knowing that the benefit that is created through cost segregation is going to be able to move over and also play a role in reducing your taxable income from your day-to-day business activities. That is very powerful. And that is something that people just need to spend a little bit of time to understand how this can kind of play out for them, and what does that mean in their total financial picture.
I like to always kind of think, we always look at in the history and the past of what's happened, but just looking out into the future. So, this year, obviously, but beyond, nothing seems to stay the same forever when it comes to legislation here in the US. So, you know, if there's a sunset or, you know, a future economic trend out there that could affect the cost segregation strategy, like if there's any like adjustments, how would that, like, what kind of proactive steps can somebody take now to take advantage of the fact that this whole thing may not stay forever? Like, new legislation, new regime comes in, and you wake up one morning, Joel, and this whole bill that's been so effective is not, like, what kind of things can we do to protect you against unexpected changes in legislations? Like, what are things that people can do? Because I always think about that.
Well, I think,
They seem to be forever, but then they're not, right?
yeah, yeah. Well, I think maybe a good way to look at it is if we go back and we look at what took place with the passing of the Jobs and Tax Reform Act back in 2017. So when that was enacted, then this 100% bonus depreciation was part of that between the fall of, let me make sure I get my years right, between the fall of 2017 all the way through the end of 2022. So all the things that we talked about, there was 100% bonus available for buildings that were placed in service during that time. Any building that was placed in service in 2023, that bonus component started to sunset. It was 80% in 2023. It was 60% in 2024. If someone purchased a property prior to, if the in-service date was prior to January 19th of 2025, then the sunsetting rules were 40% for 2025. So now you're talking about the difference between 40% bonus if you were at the beginning of the year or at the in 2024 versus now after that moving forward, you're 100%. So to your point, things could possibly change. Now, no one, of course, knows, but we would like to believe that there will still be a place for cost segregation. Could it go back to the elimination of bonus? And will we look at 5-year property to be accelerated over 5 years, 15-year property over 15? And there's the elimination of being able to wrap it together and take advantage of bonus. Wayne, you will have to look into your crystal ball and you will have to help me answer that question because I don't have the answer to that one.
I'll tell you, and again, the challenge is that we know as time passes and things change, tax laws in the US change.
Right. But I would say this, my bad attempt at humor aside, the reality is we would be hard pressed to think that things that were put in place would be reversed as it relates to this. So people that are in position to take advantage of this should look to do so. The other point that I would make is that with the bonus scenario, even through this sunset phase, what constitutes our starting point is when the building was placed in service. So maybe somebody didn't know about cost segregation. They bought a building, say in 2023, they were introduced to this just now. So because the building was placed in service in 2023, they're still going to be able to take advantage of 80% bonus. So it will still be there. The placed in service date is the actual driver as to how much they can utilize.
Okay, so we've covered a lot here today. Like, not surprisingly, I knew this was going to happen. So guys, like for the folks that are watching on our website here, Joel, they can see all of your contact information right in front of you, right underneath on the screen. But we have a ton of people listening on, Apple, on Spotify. They're driving around in their cars, or maybe they're listening at home at night. What's the best way for them to contact you? How can they get a hold of you?
Whatever works best for your audience works best for me. If it's a phone call, if it's an email, if it's a text message, I know everybody has their preferred method and mode of operandi. I know people are busy, but however people reach out, I will most certainly get back to them.
So why don't we give them the phone number? Why don't we start with the phone number?
So the phone number would be 805-680-3834. That's the best phone number to call or to text. And email address would be Joel, Joel, at costseginitiatives.com. Our web address, www.costseg-pros.com.
Joel, I cannot thank you enough. I know you're a busy man these days. Taking time out of your day to join us, really appreciate it. Again, Joel Dobrin is a cost segregation specialist with Camarillo, California-based Cost Segregation Initiative. Joel, thanks for making time for us today. Great to see you, and we'll see you soon. Thanks a lot.
Great, Wayne. Thank you so much. I appreciate it. And credit to you for immediately recognizing, wow, this probably is going to play a big role here, because you were 100% correct.
Well, thanks a lot, and we'll see you soon.
Thanks so much.
I look forward to bringing you the 3 Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episode has been posted, please click on the notifications bell. Last but not least, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.